Federal Reserve Chair Janet Yellen back on investor radars. This after the minutes were released yesterday. That was from the Federal Reserve's last meeting. It showed that an increase in interest rates is likely on the table for December. Most Fed officials seeing current economic conditions as possibly warranting a liftoff on rates at the next meeting. This as long as job growth and inflation trends do not take a turn for the worst. I know we've been talking about this for a long time, and Keith, you've been in the position that they can't raise rates because the economy is too slow. You think they're going to do it next month, though, now?
Well, I've gone with the economic view. So, again, it is a bit of a joke. Actually, it's a big joke now that the Fed is data dependent. What the Fed is actually dependent on is the S&P 500. If the S&P 500 goes down, they're not going to go. If the S&P 500 stays up, that's where they are. The data is unequivocally bearish. I mean, you can look at one jobs report. You can find a unicorn. You can do whatever you want. We had industrial production growth just came out at 0.3%. Zero. OK, we've had retail sales miss. PPI hit a new low last week. All these things are happening, and the Fed keeps saying, well, we're going to be data dependent. I mean, this has got to be the most mediocre exercise in American financial analytics in any single situation that I've ever seen. Again, we're going to wait for one data point. If that jobs report is half-baked or good enough, they're going to go, and I think it's a huge risk to equity markets.
It's really interesting. The Fed wanted to be all, transparent, and we're going to, give you forward guidance. We're going to tell you what's happening because we're going to hopefully raise interest rates as well until they were wrong.
They don't want to be transparent.
Then reality happened. Life happened.
Janet Yellen, while you're away, don't forget that Janet Yellen had an absolute conniption because of this Form Act. Again, the Form Act, which is, I got to look up the acronym, the Fed Oversight Modernization Reform Act, which is basically to audit the Fed. She says, look, you can't do that. You will ruin all my ability.
They actually have lobbyists in Washington going against that. But, this data dependency is actually showing that they are going to have to raise rates in December, and that's why they're telegraphing it. We saw it from their tour last week. I mean, you had Fed governors going all around talking about how it's a live possibility. It's now showing up in the minutes. What we've seen is core CPI come in at 1.9%, just a shade under 2%, close to their target. We saw the highest wage growth happen in over 6 years from the last job numbers that coming in at 2.5%, which they needed because that leads to healthy inflation. How much lower can we get in the jobless rate? I mean, we can't. So they are trying to telegraph it because they don't want to be politicized next year. You talk about that act. They've got to do it now so next year they don't become a subject.
What's that point in of itself? What's that quarter point going to do?
But send the message that the economy is okay.
I've heard this like way too many times. It's a stock versus flow point, or again, flow rate of change. I don't care if they raise by 1 basis point into a slowdown. Again, if you have a real analyst who's had it right on both deflation, forget the CPI. I mean, the CPI up a little bit off the lows. PPI hit new lows, producer prices. That's why you have corporate profits hitting new lows in rate of change terms. We have job firings that are coming. The Fed is going to raise rates into the slowdown for the first time. They could raise by 1 basis point, and I would have this view. The Fed has not tightened into a slowdown yet. Nobody knows what that looks like.
I don't think it's a slowdown, and we see that.
You don't?
No, because look at the non-manufacturing PMIs, right? The services PMIs. We're a service economy.
Manufacturing has been the recessionary area.
Well, yeah,
right?
but the services sector came in at 59, above the 50 level. I mean, that is a huge.
Yeah, but you got one thing. Have you listened to the conference calls of Nordstrom, Macy's, anybody yet? I mean, these guys collapsed last week. Terry Lundgren, who knows a lot more about retail than you, no offense, but he basically said it appears to me that my consumer is entering a recession.
His consumer, that company has been in a spiral, and he's been struggling to get his arms around writing. It's a department store. Some of this is a sea change within the retail industry.
Yeah, they can't tackle
There's some retailers that are doing well and some that aren't. He's one of them, and
who's doing well?
One of them. Amazon. Online retailers.
As long as all we do
online is eating the lunch of the department stores.
The direct-to-consumer market is exactly what's happening, and you're hitting the nail on the head.
Well, they're also eating Walmart's lunch, by the way.
If you've been long,
Walmart sales were okay, and the traffic was okay. Traffic was up 1.7%. Come on.
Stock has lost a third of its value year to date. Here's why the
Fed has to raise rates, because asset inflation is going through the roof. You have McDonald's trading at 21 times next year's earnings. It's a turnaround story. They missed 5 out of the last earning cycles on EPS. I mean, it's scary. People are going in because it has a 3.8% dividend yield.
That's not why people are going.
That's scary.
We can go into that. I mean, do you have an analyst on McDonald's? We have the best in the world of McDonald's. That's not why people are long McDonald's. My brother is a franchisee
Why
of
are they
McDonald's.
long
But people
McDonald's?
qualitatively will say anything like this. McDonald's is one of the best turnaround stories in the marketplace. It's actually a cheap stock on the turnaround numbers. If you don't have the right numbers, you're looking at the wrong thing. I mean,
21 times earnings, and they only for the first time in the last 2 years beat on same sales stores.
21 times whose number? Your number?
Next year's earnings.
Yeah, you're using consensus. That's the problem.
Yeah, that's true. And that's what the market trades on.
No. Actually, the market, smart people trade on a number that you don't know yet.
That's actually the problem for the market is the earnings are still too high, and you have stocks going up, and the earnings need to come down for next year.
McDonald's trades at 14 times our number.
That's a great number then.
Yeah, that's why you do research. I mean, this is the whole point. You know, the reality is it's stocks right now. I don't know how you could
But is that based off of the buyback that they're instituting from Investor Day?
It's not.
There you go. They are buying back stock. They are buying, look, we're getting all caught up in.
Let's get a real analyst on here.
Can I just ask you a question? Do you think we're going to go into recession next year? Simple question.
Absolutely.
2016.
Absolutely. I mean, all the rate of change data continues to support it. If you don't have a research team or models, I don't think that you can have an answer to this. I really don't. I think at the end of the day, there's a lot of qualitative nature to this. A lot of people have missed the slowdown. A lot of people missed the cyclical recession. A lot of people at this point are quite certain it's not a recession that never called any slowdowns to begin with.
Let's just be clear. You're talking about 2 straight quarters of contraction. You think in 2016.
Yes.
We're going to see, wow. Okay.
Yes.
Hey, you got